I think the market has been pricing a recession since the beginning of the year.
That the US economy will go into recession by the middle of next year.
Remember that looming recession everyone buzzed about earlier this year? It's here, and we're now navigating the murky waters of a stagflationary environment. With a cooling economy on the horizon, many predict a recession by year's end or early next year. Add to that the consistent rise in food and energy prices, and it seems the Federal Reserve's monetary policy is grappling to shift this tide. Interestingly, this anticipated recession isn't an equal opportunity crisis. According to Bank of America's August 2023 Consumer Checkpoint Survey, it's America's elite feeling the pinch. Sticky inflation, coupled with a fragile stock market, is burdening our nation's wealthiest. More high-income earners are flagging unemployment, making it a recession. But why should this matter to the average? It's because of the domino effect of the wealth effect. As the value of financial assets drops, it invariably leads to a dip in consumption. Given that the U.S. economy leans heavily on consumer activity, fewer spending sprees can spell stagnation for the entire economy. Let's delve deeper into why this recession isn't just a high-class problem but an everyone problem. 2022 was tumultuous. The stock market took a nosedive and what was previously unthinkable happened. Home prices began to wane, especially in those booming markets where tech was king. As the tech sector cooled, its ripple effects were felt in real estate. These twin blows significantly dented the net worth of many households in that year. However, 2023 saw a glimmer of recovery. The markets began to rebound, though they hadn't touched the dizzying highs of early 2022. By summer, there was a subtle bull rally, surprising many, especially in light of rate hikes. The hero of this rebound, a resilient consumer sector. But not everything was rosy. The economic challenges witnessed at the beginning of the year persisted. There wasn't a silver bullet or some miracle turnaround. While some were optimistic, the overhanging cloud of uncertainty remained. And amidst all this, inflation's sting was palpable. Even the affluent weren't immune. The era of revenge spending post-lockdown saw many dig deep into their savings, and an increasing number turned to credit cards, desperately trying to maintain their lifestyles in a faltering economy. The repercussions were starkly evident in the job market. Companies paralyzed by recession fears drastically reduced their listings. Recent stats paint a grim picture. Banking and finance jobs plummeted by nearly 40%, and tech roles, they witnessed a staggering 50% drop from just a year ago.
The headline here is that any bank not led by Jamie Dimon has been cutting jobs this year. If you look at the big six banks who've all reported, Wells Fargo is the biggest sort of perpetrator here. They've cut about 11,000 jobs, or about 5% of their workforce, just this year alone.
Thousands are losing their jobs in the tech world. The giants aren't immune. Microsoft has announced 10,000 layoffs, while Alphabet, Google's parent company, is slashing its workforce by 12,000. This grim trend follows earlier announcements of significant cuts by Amazon and Salesforce. Notably, it's not just tech feeling the heat. Wells Fargo and Saks have hit roadblocks, especially with high interest rates becoming a persistent challenge. According to UBS's 2023 Global Wealth Report, the U.S. saw a shocking decrease in its millionaire count, losing 1.8 million in 2022 alone. The primary suspect? A faltering stock market. The S&P 500 took a brutal 19% hit that year. Bank of America's August 2023 Consumer Survey painted a troubling portrait. High-income households are growing wary, showing diminished economic confidence. Concerns? Soft wage growth and dwindling job creation opportunities. It's evident in the rise of unemployment claims among this segment. Surprisingly, many of these wealthy households are feeling the pinch. Struggling to keep up, they are increasingly relying on credit to bridge the gap. A telling sign. Credit card debt in the country has mushroomed to a staggering $1 trillion. And even though these households are purchasing more discretionary items, it signals more caution than luxury. For the wealthy, their fortune's fate largely hangs on the stock market's performance. And while there was a brief rally in the summer of 2023, looming threats persist. Surging bond yields and the prospect of enduring higher interest rates paint a bleak picture. Some analysts speculate that with interest rates soaring, we might be looking at a prolonged weak stock market phase. What does this mean? Potentially less wealth creation. While it might not spell outright wealth destruction, the growth rate could be stunted, and the ripple effects could be vast. Industries that thrive on the spending power of the affluent, be it luxury real estate, high-end fashion, or the elite automobile and aviation sectors, may all face headwinds. Their trajectory, in many ways, will be determined by the stock market's performance in the coming year. Recent reports have unveiled a surprising trend, a decline in U.S. luxury sales. This downturn, not witnessed since before the pandemic, raises eyebrows. For instance, the luxury behemoth LVMH, known for its consistent success, reported an unforeseen 1% dip in U.S. sales. This is even more shocking considering Richemont, owner of prestigious brands like Cartier, revealed a 4% drop in the U.S. It's well known that the top 20% of Americans, in terms of income, drive over half of consumer spending. Historically, this segment has wielded significant influence in buoying the economy, especially when the middle class has faced challenges. These affluent consumers, with their considerable buying power, have consistently kept the cash registers ringing, championing sectors like fine dining, luxury vehicles, and significant charitable contributions. However, the relentless persistence of inflation has caused even this elite group to rein in their spending habits. Their traditional indulgences are now seeing cutbacks. The uncertainty enveloping the market has left investors treading cautiously, grappling with unclear future prospects. This cloud of unpredictability hampers their investment decisions, leading to a scenario of low visibility. Consumer spending is the lifeblood of economic activity. So, when the affluent tighten their purse strings, it's not just luxury brands that suffer. Their reduced spending can stymie the nation's economic rebound. For a robust recovery, it's essential for this segment to maintain, if not increase, their consumption. Their spending ensures the vitality of consumer-driven businesses, ensuring their profitability in an ever-challenging market. Despite economic uncertainties, the global forecast for the wealthy appears promising. UBS's projections signal a wealth surge, estimating global riches to skyrocket by 38% in the next 5 years. By 2027, the worldwide wealth tally is set to reach a staggering $629 trillion. This boom also heralds the rise of a new millionaire class, with their numbers projected to burgeon to 86 million, a significant leap from the 59 million recorded in 2022. While the U.S. economy faces potential headwinds from an underperforming stock market and a looming recession, these conditions might be the silver lining for America's affluent. Currently, the sentiment among the wealthy is somber. The persistent specter of high inflation and sustained elevated interest rates raises concerns about the devaluation of their assets. Interestingly, wealthy households often display financial prudence during uncertain times. A substantial portion of their portfolio remains in cash, a strategic move centered on wealth preservation. As turbulence engulfs the economy, a trend emerges. High net worth investors increasingly gravitate towards safe haven investments. Their strategy? Brace for impact now to seize opportunities later. Historically, recessions have paved the way for savvy, wealthy investors to amplify their fortunes. An age-old adage quips that recessions are akin to garage sales for the rich. It's during these economic downturns that valuable assets often become available at distressed prices. For the astute, wealthy investor, these are golden opportunities. They dive in, purchase undervalued assets, and patiently wait. As the economy recovers and asset values bounce back, their wealth multiplies, solidifying their position atop the financial ladder. The tide of the economy is challenging, yet within its waves lie hidden treasures for those astute enough to seek them. Despite the recent downturns, especially affecting America's wealthy, it's essential to remember that recessions have historically been golden opportunities for the astute investor. By holding on to their strategic insight and leveraging their substantial economic influence, the wealthy not only have the potential to bounce back, but also to usher in renewed growth for the broader economy. Now, more than ever, it's vital to stay informed, be adaptable, and maintain a forward-thinking approach. The world's economic narrative is evolving, and for those prepared to navigate its intricacies, the horizon promises rich rewards. Stay tuned, stay resilient, and most importantly, stay prepared to seize the opportunities that lie ahead. If you found value in this content, please help us grow. Subscribe to the channel, hit the like button, share with your friends, and leave your comments below. Your engagement makes all the difference and helps us continue producing quality content for you. Join our community now.